You know that feeling. Just scrolling through news, and it's like everything's shouting at once, and you're just trying to figure out what actually matters.
Totally. Yeah, it's information overload.
Well, our source material this week kind of kicks off right there. It says, it's not hard to find concerning data emerging on multiple fronts.
Right.
So that's kind of our mission today, I guess, trying to cut through some of that noise.
Exactly. We've got a stack of recent financial analysis here, and we're going to dive into what the experts seem most worried about right now, economically speaking, market-wise.
Think of it as us doing the legwork so you get the key takeaways without, reading every single report.
Mm-hmm. And our main source for this deep dive is the CLSA Bits and Pieces report. This one's from May 2nd, 2025.
Okay.
And it's interesting because it flags potential problems, sure, but it also touches on some potential strategies for navigating things.
And we're not just looking at the big picture, right? There's specific company stuff in there.
Yeah, specific analyst takes on companies, and we've even got input from Dan Tapiero, the market vet, and his AI, which is called The Prophet.
Oh, interesting. An AI perspective.
Yeah. So looking at all this material, there are kind of two big themes that jump out.
Okay.
First, you've got these definite anxieties floating around, potential economic slowdown, market instability, that sort of thing.
Uh-huh.
But then there's this counter argument almost, a different view suggesting that maybe the way policymakers and markets react could actually pave the way for a recovery.
Right, the reaction itself being key.
Uh,
Okay, so where do we start the worries?
let's start there. The CLSA report has these charts of concern, and they don't exactly mince words.
No, I saw that. One section title is Ding Ding, Here Comes the Shate Mobile.
Huh? Yeah, a bit direct.
Definitely gets your attention.
It
So what's behind that particular warning?
Well, it seems to stem from an observation by one of their analysts, Johnny Chen. Bloomberg reported on it. He noted a, quote, dramatic drop in China container heading towards U.S.,
Okay, when was this?
apparently right after some new tariffs got implemented.
Ah, okay. Cause and effect, maybe?
Potentially. The report suggests it could be because big retailers, your Walmarts, Targets, maybe Costco, and even smaller businesses might have just hit pause on orders from China to the U.S.
Putting the brakes on.
Yeah. But like a lot of things in global trade, it's not entirely straightforward.
Oh.
The report also brings in insights from Ryan Peterson, the Flexport CEO. He's apparently seeing more containers coming into the U.S., but from Vietnam.
So a shift, not necessarily a total drop-off, just coming from somewhere else.
Could be part of it. It just shows how interconnected and, frankly, how fast things can change.
But the overall vibe from CLSA on this data is still pretty cautious, isn't it?
Oh, definitely. They use phrases like heading south fast, a not-so-bright immediate future, not a positive mindset. It definitely leans towards concern.
Not exactly confidence-inspiring.
No. And it's not just trade figures either. They also flag worries about housing.
Ah, yeah, I saw the note. High house prices plus higher int rates.
Mm.
No thanks.
Pretty much sums it up, doesn't it? That combination just makes buying a home really tough for a lot of people, and that can definitely put the brakes on the market.
Okay, so warning signs flashing on trade, on housing.
Yeah.
It paints a picture.
It does. But then the report pivots a bit and talks about this duck and cover strategy.
Duck and cover.
Uh,
Like the old Cold War drills. Hiding under desks.
exactly that. It's an analogy, obviously,
For what? In this context?
for seeking safety in stocks that pay high dividends when the market feels shaky.
Ah, okay. The safe haven idea.
Sort of. The
Mhm.
thinking is these companies offer a dependable income stream through dividends, and ideally they have a track record of maintaining or even boosting those dividends, even through tough times like, say, the pandemic.
Right, so consistency is key. But the analogy, hiding under a desk wasn't actually going to save you from a nuclear bomb, was it?
Huh. Well, that's kind of the underlying caution here, too. The report mentions this. While the dividends provide income, like a small raft maybe, it might not be enough if a real financial tsunami hits.
Got it. Income stream, yes, but maybe not full protection if things get really bad. Do they mention specific stocks?
They do. A few examples. Elsie Sheng discusses Luzhu Laoshao. It's a Chinese liquor company.
Okay.
She notes it's consistently raised its dividend per share for at least 7 years straight, and she points to their dividend payout targets for the next few years, which imply pretty attractive yields.
What sort of yields are we talking?
Around 4.6%, 4.7%, which, in this environment looks pretty good. They see it as offering decent downside protection.
Okay. Who else?
Then there's Brian Lee looking at KT&G. That's a South Korean company. He's forecasting an even higher yield, maybe closer to 10%.
10%. Wow. How?
Well, it includes both the regular dividend and cash returns from the company buying back its own shares. Plus, they're apparently selling off some non-core assets, which could also benefit shareholders.
Interesting. Any others?
One more highlighted is SCBX Public in Thailand. Analyst Rathakorn Prijaratuporn picks this one, also pointing to a really attractive dividend yield, again around 10%. It's their top pick among Thai banks.
So there's clearly a theme here. Investors are chasing yield.
Absolutely. The report explicitly says high dividend yielders are surging because high inflation drives a thirst for yield.
Makes sense, right?
Yeah, you want your money working for you, generating income.
And there's a perception thing, too. Companies know that cutting dividends looks really bad. The report calls it anathema. But hiking them, that looks like good management, good governance.
Right. Signal strength. But back to the duck and cover warning.
Yes, the big caveat. The report itself questions how much shelter these stocks would really provide in a serious downturn.
So even with rising dividends, the initial hit to the stock price could still be painful.
Could be very painful. The underlying stock value could drop significantly if the broader market tanks, potentially wiping out the benefit of that dividend income, at least in the short term. It's not a magic shield then.
Probably not. It might cushion the blow, but maybe not prevent it entirely.
Okay, so that's the sort of cautious, maybe even slightly anxious view. Find some yield, but don't expect miracles if things go south.
That's a fair summary of that part.
But then you mentioned Dan Tapiero and an AI. This sounds like a totally different angle.
It really is. The report brings in this tweet from Tapiero back on April 18th. He was looking at the VIX, the volatility index.
The fear gauge.
Right. And it had spiked up to 60. Tapiero points out, look, hitting 60 is rare. Only happened a handful of times in the last, 35 years.
Okay, so extreme fear. What's his take on that?
His point is historical. When the VIX gets that high, when that level of fear and uncertainty is basically priced into the market, well, historically, things tend to look better 6 to 12 months down the road.
So extreme pessimism can actually be a contrarian buy signal.
That's the idea. It's like the fear itself gets exhausted. And he expects this extreme level might trigger policy responses.
Ah, okay. Like what?
He specifically mentions the possibility of Trump softening his stance on certain things, the European Central Bank maybe cutting rates, China rolling out stimulus, policymakers stepping in.
Right, trying to calm things down. And this is where the AI comes in. The profit.
Yes, and this is fascinating. The Profit AI responds to Tapiero's tweet. It agrees, yeah, VIX 60 is a huge deal, but it argues it signals something deeper than just fear.
Deeper how?
It calls it the exhaustion of narrative compression across multiple subsystems.
Okay, that's a mouthful. What does exhaustion of narrative compression mean in plain English?
Yeah, it's dense. I think it basically means the standard stories or models we use to understand how the economy, policy, and money markets all interact. They're just not working anymore. They're breaking down under stress.
So the usual explanations fail.
Kind of. The AI suggests this VIX spike isn't just panic. It's a sign the financial system itself is struggling to absorb the macro stress. It mentions things like liquidity structures failing, weird stuff happening with derivatives hedging, and even policy itself becoming a source of volatility, leading to what it calls systemic unhedgeability.
Meaning you can't even insure against the risks anymore because they're too big or unpredictable.
That seems to be the gist. It's like the whole system becomes too fragile to manage risk effectively in the old ways.
Wow. Okay. Does the AI offer examples?
It does. It points to VIX 60-plus events historically coinciding with what it calls narrative overcorrection and a liquidity restoration window. It cites 2008 with Lehman Brothers,
Right.
Point 2020, the start of the pandemic,
Okay.
and even March 2023, the Silicon Valley Bank collapse.
So moments of crisis that led to big interventions.
Exactly. Massive liquidity injections often followed those kinds of spikes. The AI argues that the instability we see now across currencies, bonds, stocks is likely setting the stage for a similar, probably coordinated policy response.
And the AI says market improvement after these events isn't just because stocks got cheap.
Right. That's a key point. It's not just bargain hunting. It's that the system itself reflexively adapts. The high volatility exposes the flaws in the old ways of thinking, forcing an adjustment.
A painful adjustment, but an adjustment nonetheless.
Seems so. And regarding those potential policy moves Tapiero mentioned, Trump, ECB, China, the AI frames them less as traditional easing to boost growth
And more is what?
More as stabilization maneuvers, trying to prevent a complete meltdown.
So stop the bleeding rather than stimulate growth.
That's the interpretation. Preventing systemic risk repricing, stopping credit spreads blowing out, avoiding chaos in currency and credit markets. It's about putting a floor under things.
Okay. And how does the AI see investors reacting after a volatility spike like this?
It predicts stages. First, money rushes to safety, think U.S. Treasuries, liquidity seeking shelter.
Makes sense.
Then you get technical adjustments like volatility-focused hedge
They are a
funds,
big
vol
thing.
carries resetting their positions. And then eventually capital starts to flow back into what it calls high conviction assets. It mentions crypto, gold, AI, potentially benefiting then.
So a sequence. Safety, reset, then selective risk-taking.
That's the predicted pattern. And the AI's bottom line, it actually agrees with Tapiero that the odds favor a better future ahead.
But for a different reason.
Kind of. Not just because fear fades, but because all that capital has to go somewhere. It needs to re-enter the market as volatility calms down, and that process itself leads to a repricing, especially as policymakers work to restore confidence in the system's plumbing, basically.
Restore confidence in the flow of money.
Exactly. And interestingly, the CLSA report itself kind of circles back to this in its conclusion. It wraps up by highlighting Dan Tapiero's view that ultimately all these ugly data points, all this concern, it's going to force a response.
And that response is
Liquidity, in all caps, and more of it.
more money pumped into the system to keep things moving.
That seems to be the ultimate expectation.
Okay, so wrapping this all up then, we've really looked at two quite different takes here in this deep dive.
Definitely.
On one side, you've got the clear worries, those charts of concern, the blunt schmibobble warning pointing to real risks of an economic slowdown, market bumps.
Yeah, the cautionary tale.
But then you have this other perspective from Tapiero, and particularly the profit AI, suggesting that maybe extreme stress and volatility can paradoxically create the conditions for a turnaround.
Right. Driven by those policy responses, the stabilization maneuvers, and that eventual return of liquidity.
So for you listening, try and navigate all this. It highlights how complex things are. That duck and cover dividend strategy, it might offer some income, some cushion.
But it's probably not a foolproof plan if we hit major turbulence. There are still risks.
And on the flip side, the very things causing anxiety right now, the volatility, the worrying data, might actually trigger policy shifts that could create entirely different opportunities down the line.
It's that dynamic interplay, action, reaction.
So maybe the final thought for you to chew on is this. Considering these two contrasting narratives, the slowdown fears versus the potential policy-driven recovery, what signals, what indicators will you be watching most closely over the next few months?
Yeah, what will give you a sense of which way things are actually tipping?
Because it really feels like how that economic data, the policy reactions, and just overall market mood all interact. That's going to be absolutely critical in figuring out what comes next.